lower than the budget. And again, government cut use of goods and services by 29%. They cut other expenditure by 25%. They cut capex by 11%. And grants to other government units, they cut by 5.5%. In 2018, total expenditure was 2.2% lower than budget, landing at 58 billion. Government cut capex by 31%. They cut other expenditure by 13% and grants to government units by 10%. However, the use of goods and services was increased by 44%. And interest payments was also 6.1% above budget. In 2019, total expenditure was 67 billion. Again, government ended up 6.7% lower than budget by cutting capex by 27% and cutting grants to other government agencies by 17%, and other expenditure was also cut by 17%. 2020, however, due to the COVID pandemic, total expenditure rose significantly to 96 billion, driven largely by 348% increase in other expenditure, 30% increase in capex, 13% increase in interest payments. And government, however, cut grants to other units by 24% and use of goods by 11%. 2021, total expenditure rose above 107 billion cedis, 2% lower than budget, and then the cuts were largely driven by 9.4% savings in the interest payments, and then 14% cut in grants to other government institutions, 11% on other expenditure. The compounded annual growth rate of total expenditure from 2017 to 2021 was 20%. Year-on-year growth increases was 11% in 2018, 16% 2019, 42% 2020, and 11% in 2021. Government is projecting 25% year-on-year growth in total expenditure for 2022. However, based on the recent press release by government has indicated their intention to cut expenditure by 20% on a quarterly basis, as well as match expenditure to revenue collected. Compensation of employees is the largest expense item, averaging 31% of total expenditure from 2017 to 2021, and has increased by 18% on a year-on-year basis, by a CAGR of 18% over the period. Government is projecting 8.6% increase in 2022, and during the forecasting, we've maintained compensation at the same level for forecasting purposes. Ideally, government should consider a freeze in new hiring into the public sector to aggressively bring this percentage below 25% of total expenditure. Interest payments is the second largest expense item, averaging 27% of total expenditure. Interest payments have increased by 24% over the period, and this year, government is projecting a 15% increase in interest payments. This again has been maintained in the forecast. Grants to other government units has been cut by 20% based on guidance given by government that they would cut expenditure. Capex has been lowered by 24% considering the history of government being able to lower and cut capex. However, this reduction has been largely due to cutting on the domestic finance section. Foreign finance capex has already been budgeted, and agreements have been signed, and hence that has been maintained because government historically has not cut foreign finance capex. Use of goods has been maintained in the forecast, resulting in total expenditure reducing by 8.2% to 124 billion for the purpose of forecasting. This is to ensure that we maintain the overall balance at the 37 billion cedis, so we can check how government is going to achieve its financing for the year. It's worth noting that government can deliver a more aggressive expenditure cut if they cut use of goods, grants to other government expenditure, grants to other government units, other expenditure, and domestic finance capex by 50%. They can achieve a 20% cut in overall expenditure. Now, on to the next slide. In 2017-2018, fiscal deficits was 5.9 and 3.8%, lower than the budget. However, 2019-2020, fiscal deficit ended up higher than the budget, 2020 obviously being impacted by COVID. 2021, based on the revised budget, government has indicated they are on budget to achieve the 9.5% targeted. For the purpose of forecasting, we've assumed that the overall fiscal deficit will be the same to enable us to analyze government's financing options for this year. However, assuming government delivers 20% cut in total expenditure and revenue and grants falls by the 11% forecasted, the overall balance on a cash basis drops to 21.5 billion cedis, which is 4.3% deficit. So it is achievable to get below 5% deficit if government wants to. Now, moving on to the next slide. Financing the budget is a major concern considering Ghana's lack of access to the Eurobonds market. Sovereign financing, largely via Eurobonds, was approximately 44% of total financing in 2018, was 80% in 2019, and then fell down to 17% in 2020, 35% in 2021. In 2022, government has forecasted 13% of sovereign financing via syndicated loans, which may be achievable this year. However, the syndicated loan market is not as deep as the Eurobond market. Hence, government may face challenges raising future financing via syndicated loans in later years. External financing has lowered interest costs compared to domestic financing. However, government is exposed to exchange rate depreciation and the impact of this on total debt stock as well as debt service. Foreign currency debt as a percentage of total debt was 52% in 2017, 48% in 2018, 50% in 2019, and 46% in 2020. The weighted average interest for external debt was 4.3% in 2017, 4.5% in 2018, 5.1% in 2019, 5.3% in 2020. Whereas domestic debt was 17.4% in 2017, 16.5% in 2018, 17% in 2019, and again 17.2% in 2020. The weighted average total cost of Ghana's debt for the total, if you look at both domestic and foreign, was 10.6% in 2017, 10.7% in 2018, 11% in 2019, 11.7% in 2020, and 11.6% as of September this year. In 2022, government has a target, a net domestic financing target, and it's always good to stress the net, of 28 billion cedis, which looks feasible considering it was 45 billion in 2020 and 30 billion in 2021. However, one major concern is the activity of non-resident investors in the domestic market. Non-resident investors have been repatriating coupons and bond maturity proceeds in recent months, in addition to periodic bond sales on the secondary market. Based on CSD data, non-resident investors will receive approximately 5.2 billion cedis in bond maturities and 4.8 billion cedis in coupons this year. Assuming this amount is not reinvested, the government must either raise this additional money from local investors, which can be done by offering higher yields, or significantly cut expenditure by 10 billion cedis, which will be challenging. For 2022, government has programmed $700 million in the SDR that was received from IMF to support the budget, and can also access approximately 144 million cedis from the stabilization fund if required for liability management, and that's based on the law. Government may resort to building up arrears, as we've seen historically, if it's unable to raise sufficient financing. However, this approach would only result in a much more severe physical stress in the medium term, and hence should be discouraged. Total debt to GDP as at November was 78.4%. However, if the ESLA bonds, Dachi bonds, and the financial sector bailout costs are added, then your total debt to GDP rises well above 80%. The high debt to GDP rate itself is not necessarily a challenge if interest costs are relatively low, as evidenced in countries such as Japan and the US. However, as indicated earlier, the weighted average cost of total debt in Ghana may well rise above 12%, considering the rise in domestic interest rates and government's reliance, or government having to rely on domestic financing in the medium term. Moving on to the next slide. The gross international reserves for Ghana have increased from 5.4 billion, representing 3 months import cover, in 2012 to 9.7 billion, representing 4.4 months import cover as at end of this year. The build-up in reserves was supported by external financing by government via Eurobonds. However, this trend is unlikely to continue as Ghana does not have market access. The cedi experienced a period of relative stability in the past 5 years, with annual depreciation averaging approximately 8%. Again, there are different exchange rates on the market between the Bank of Ghana rates that are published on their website and the interbank traded rates. So, depending on who is calculating, the average depreciation rates for the year may change. It's worth noting that non-oil imports have not recovered from the 2012 levels of $14 billion. And expectations are that with government undertaking an expenditure-led consolidation, non-oil imports will remain at current levels or may even decline this year. SCB Research and the U.S. Energy Information Administration had forecasted average Brent crude price for 2022 at $67 per barrel and $75 per barrel, respectively. However, due to geopolitical tensions between Russia and Ukraine, as well as supply concerns from Libya, we've seen a revision of forecast, with Barclays forecasting oil to average $85 a barrel this year. And we expect the others to also follow suit with revised forecast. Although Ghana is a net oil exporting country, if you net the value of exports vis-a-vis the value of imports, the impact of oil export proceeds on the exchange rates are limited, as most oil exporting companies have retention agreements which enable the companies to retain their offshore. Proceeds from oil sales by government are channeled to the Heritage Fund, GMPC, and a portion for budget financing. Hence, only a small portion actually filters into the FX market. In 2012, with the Brent cruise above $110 a barrel, oil imports into Ghana was at $3.3 billion. However, this included oil for power generation. Although Ghana is not expected to import similar levels of oil for power generation as compared to 2012, the rising price of Brent crude is a potential source of external imbalance that needs to be monitored. It is worth noting oil prices have crossed $90 a barrel. Other key factors which will impact FX reserves are activities of non-resident investors who have approximately $1.5 billion in coupons and maturities this year, interest payments on external debt, including Eurobonds is also estimated at $1.5 billion this year. In 2022, government forecasts oil export proceeds to average $1 billion, assuming oil price of $61 per barrel in the budget. Adding this value to gold exports of $6.8 billion, which is the full amount achieved in 2020, and assuming cocoa exports are $2.5 billion in 2022, gives a total dollar inflow into the country of about $10.3 billion. Now, assuming total imports of $12 billion for 2022 gives you a net FX outflow of $1.7 billion for trade activities this year. In a stressed scenario, we assume government is able to raise the $750 million from the syndicated loan, add that to $9.7 billion gross international reserves, deduct the $1.7 billion net trade activity, deduct $1.5 billion for external interest payments, deduct $1.5 billion for non-resident investors who may be exiting the market this year, and your gross international reserves drops from $9.7 billion to $5.7 billion, representing 2.6 months import cover. Now, just to reiterate, Bank of Ghana's reserves are quite healthy, and Ghana does not have a balance of payment challenge at this point in time. There are several tools that Bank of Ghana can deploy to manage FX reserves during a scenario, and market expectations are that gross international reserves will remain above 3.5 months import cover this year. Whereas Ghana is unlikely to experience a drastic deterioration in FX reserves this year, there are concerns that lack of market access in the medium term may result in significant deterioration of FX reserves in the medium term, considering the external interest payments that are due in 2023 and 2024, which average about $1.5 billion each year, coupons and maturities due to non-resident investors in 2023-2024, and also we have $1.5 billion of Eurobond maturities in 2025. So therefore, it's imperative that government undertakes the necessary actions required to restore market access to be able to at least undertake liability management in the medium term to avert any potential crisis in the market. So to our last slide. In summary, it's essential government implements revenue mobilization strategies such as passing the e-levy bill, restoration of benchmark values on imports, and enforcement of tax compliance to achieve revenue estimates in the budget. Government also needs to improve on budgeting process to ensure that it promises and over-delivers on the revenue projections in future years, as it's failed to achieve revenue estimates in the past 5 years. Expenditure-led consolidation is critical as new revenue measures may take time to generate the required results. Government has proposed 20% cut in use of goods, other expenditure, and capex. However, to restore market confidence, government should consider increasing the quantum of expenditure consolidation by cutting total expenditure by more than 20% this year. Government needs to deliver a combination of revenue mobilization and expenditure consolidation to ensure it restores market confidence of rating agencies and access to the Eurobonds market. Foreign financing via syndicated loans and other concessional partners such as World Bank, African Development Bank, and the European Union will be limited. Access to the Eurobond market is essential for liability management considering the large 2025 bond maturities. Reliance on domestic financing without participation of non-resident investors will result in additional challenges in financing and translate to higher domestic interest rates. Inflation is projected to remain elevated in 2022, considering the impact of low base effect in H1 last year, as inflation printed at 7.8 in May last year. Inflation may well print between 13 and 15% in the near term, depending on a number of factors, including political instability in Burkina Faso, which may impact food prices in Ghana, the higher oil prices, impacts of restoration of benchmark values on prices of imported goods, and the like. However, the expectation is that inflation will fall below 10% in the medium term. Bank of Ghana, being inflation targeting, is expected to hike policy rates considering the inflationary pressures in the near term. Potentially a 50 basis points hike in January may be expected if the committee sees it likely. However, market expects between 100 to 200 basis points hike if inflation remains elevated. Bond yields may very well adjust upward from where they are by 100 to 300 basis points, subject to the quantum of domestic borrowing required by government based on how they implement their expenditure-led consolidation, as well as if the participation or otherwise of non-resident investors in the market would also have an impact on bond yields. FX depreciation last year, based on Bank of Ghana's calculation, was 4.09%. Based on the interbank market, was 8.26%. In 2020, considering the potential FX outflows as detailed, we may see currency depreciation range between 8% on the low side and 15% on the high side. Government is walking a tightrope, balancing on one side the political pressures to spend to drive growth, and on the other side the need to ensure confidence in the economy. To ensure that confidence in the economy is restored by increasing revenue and as well cutting expenditure at the same time. Balancing political aspirations and economic prudence is never easy, and the decisions taken today are being watched keenly by market factors, by market players. Failing to achieve the right balance on its own to successfully restore market access, government will have to engage the IMF. Thank you.
Thank you very much, Jojo. Thank you. I told you he's a numbers person. He couldn't have captured it better. The picture at the beginning tells us the story. It's not easy. And during the panel discussion, and I'll take, we don't have a lot of time, but I think we'll be able to explore just one of the things he said about debt to GDP and the cost of borrowing. Because this, if government is to borrow all that they need in this market, not all that they need, but a significant part in this market, then we all have a role to play. And we can have a discussion that elevates, it moves the discussions forward. We want to engage and see what our role is in this market. But I'll bring up our next speaker. She's Na Louisa Nelson. I like the name because this is the first time I'm hearing Na Louisa. She's a cross-assets analyst, and so she has experience in analyzing both debt and equity markets. What she's done before, she's worked with Acre Impact Capital in the UK as a research associate and a financial analyst at Cvest Africa. She also loves numbers. She holds a master's degree in investment management from Cranfield University in the UK. And she's an actuarial, well, she studied actuarial science and pursuing the Actuarial Society's a prestigious designation. So with a warm welcome, let's invite Na Louisa Nelson.
Good evening. If you don't mind, I will take this off to just help with my breathing. Is that all right? Okay. Is the clicker working? Or you would? That's fine. I hope everyone can hear me. Okay, so as already advertised, my name is Na Louisa Nelson, and honestly, I'm not hiding any interesting Ga name between the Na and the Louisa. I'm one of those interesting Brazilians from Jamestown, so that is why my name is like that. And when Nana Yafi texted me that, hey, are you interested in doing this? The first thing I said was, whew, I have to get a dress with very big hands. So now I have a dress with very big hands. So I dabble in a couple of things on a daily basis as work, but today I get to wear my equities hat. Here to give a few pointers about what might happen in the equity markets, and emphasis on might happen in the equity markets. So I'll give a bit of color, and then we'll go into the forecast. Is that all right? Okay, so the equity markets have been quite interesting. We've had a lot of so-and-sos, we've had a lot of could have beens, we've had a lot of must have beens. And if you can go to the next slide, please. So yeah, we had a very good run last year. We have some bragging rights. We were the second best African stock exchange, just right behind Zambia's Lusaka Stock Exchange. But for equity investors, we try not to be myopic. We have to look back, and we did a 5-year analysis because of the quality of data we have in our markets. And just doing a 5-year analysis, you realize that the Ghana Stock Exchange has quite underperformed some of the other stock exchanges in the African market. And we see South Africa, we see Nigeria, and I won't really pinpoint Nigeria because, as you can see, the jagged lines there, there's been a lot of volatility in their markets. And then there's the S&P, which did about 109%, which is quite interesting because they are way up there. And that's why at Blackstar, one of the products we offer is the equity beta, which helps you access global stocks. So yeah, Ghana Stock Exchange did about 11.11%. That's in dollar terms. If you can move to the next slide, please. And we want to see how the exchange has done in terms of numbers. So if you can move to the next slide. So we've had a declining number of stocks on the market. And I've heard time in and time out again, the GSE advertising aggressively for stocks to be listed on the market. Can we move on to the next 2 slides? So the GSE has grown about 14% since 2015. On the USD side, it's quite an interesting picture because of the currency play in there. We've done about negative 28% with growth. You see us moving from 57.12 billion to 65, and that's just about 14%. It doesn't really paint a pretty picture. That's the could have beens and the must have beens, and I'm just here to point that out. If we can move to the next. So we want to move straight into our forecast, and we decided to do some forecast themes. And the first one is the allocation effect. We want to see the battle between fixed income and equities. So if you can move to the next slide. So that's fixed income and equities. The next one. So we have our money movers, and the big guys are the banks. But then we also have our pensions, and a lot of us here work with some pension cash. And averagely, just looking at tier 1, that is SNIT, you have like a 43% split between equities and fixed income. So equities have done averagely about 40% year-on-year allocation from 2010 to 2015. And bear with us, we didn't have data available from 2019 to 2021. But SNIT has quite done well with allocations to equities. If we come to tier 2, tier 3, if you can move to the next slide, please. It's quite interesting because the old MPRA regulations talks about 60% govies, 20% equities. Last year, they released their new directive, which gave 15% more to fixed income. Again, the battle. So it moved to 75% allocation to fixed income, that's govies, but it still maintained 20% to equities. And what's the impact of that? Can we move? So there is a data where they take the top balance funds and collective investment funds, and they've done a whopping 96% allocation in fixed income, but equities is just a tiny bit, 4%. And if we can look in the next slide. So what do we really see with this? We're looking at total volumes traded, and the secondary markets last year did around 208 billion, and Abnamwa, I tip my hat out for you. But then if we look at the equity markets, about 6.5 billion, but this is not just last year. If you do a calculation of equities since 2013 to 2021, then you are going to get that 6.54 billion. And that is the allocation effect we are seeing right now. If you go, moving into the float effect, just if we can go on to the next slide. So with the float effect, we are looking at the equities. So what if we solve the allocation problem this year? Will the equities market be able to handle the kind of volumes that go into the secondary market? Nope, they will not be able to do that because we have some very closely held stocks. We don't have a lot of trades going on, 6.54 billion, 2013 till date. Come on. You have top market shares for last year. We see MTN up there chilling with the big boys. Carl trying to bum here and there. And then we see the others coming in. So if you go to the next slide, MTN has about a 10.3% float, and Carl has a 24.8%, and the others come in. ETI is about 70%, but it doesn't trade as much. So if we go down, we'll see MTN having a market cap of about 13.64, and only 1.4 billion of that is tradable. And out of that 1 billion, last year we did about 365 million. That should tell you that a lot of these stocks are closely held. So even if we fix the allocation effects this year, it will be very hard for the equity markets to take such volumes that we're seeing in the fixed income market. So just the last slide on float effect. Total market cap for last year as at December 2021, 64.43 billion. If we float adjusted for all the various shares on the market, we are going to have about half of that being able to trade. But again, a lot of these are closely held, so you don't see the figures and the volumes that we need to see for some good capital appreciation on the market. Moving into the meat of the conversation, uncharted waters. COVID has hit us hard. It has left us with a lot of uncertainty. We don't know our left from our right at the moment because you don't know what is going to happen. You don't know how you're supposed to position your portfolios. So let's look at the next slide. So this is an interesting chart, and it has shown that GDP growth is the main mover of equities. So as a country grows, your companies grow, your equities do good. So if you see around 2011, we can talk about maybe the oil effect, so you can see maybe some disparities here and there. But you move into 2014, you see GDP growth going down, equities going down. You move a bit further, GDP growth going up, equities going up. And mind you, this is a composite index, not the financial index, because the financial index is in the composite index. Again, you look at just 2021, GDP going up, equities going up. So we've come to a conclusion that GDP growth is the bedrock of equities. So if you look into the next slide, we see GDP projections for this year. The World Bank calls it at 5.1. IMF penciled it at 6.2. Bloomberg consensus a bit on the downside, 4.9. So we have the band range of 4.9 6.2. I think that we are within range to safely say that there might be a lot of increases in the equity markets because GDP has been projected to go up. If we look on the next slide. So this chart is quite interesting to me specifically because we as a country should really, and I want to leave this with us today, that we as a country should really think about it, a resource-rich country, and our country is being driven by our service sector instead of rather our agriculture sector and our industries. Industries are doing quite poorly. We are still in negative territories in terms of growth. Our mining sectors are pulling us down because of the shutdown from COVID. They are now rebooting. So we don't see as much growth there as we should normally see for a country like us. But services sector is projected to grow really well this year. Same with agriculture sector, and services sector is a bit on the high side compared to agriculture sector. So if we go to the next slide again. The anthem of last year, high rising inflation. You have a lot of inflation fears, people saying, where's inflation going really? And we've seen a 5% increase, May, low, that the last time we went there was around 2013. Everybody was excited about it, people were talking about it, we're at our lowest, then we began to climb, and we are still climbing. You have us going, but you know what? We've been quite high before. If you look at the charts, and as I said, as a researcher, you don't just look at what happened last year, last 2 years. We try and forecast. We try and look way behind, and we can see that we've been in the 45s before. Can you imagine that time? Inflation of 45%. But now we're not up there yet. And if you realize, before COVID, we were kind of trending downwards with inflation, and COVID hit and kind of mixed everything up for us. But yes, we've been on the high before, and we are not yet there. And hopefully, we will not get there anytime soon. So if we move to the next slide. So with inflation, we saw the monetary policy take a hawkish stance. That is, they're increasing rates they're increasing the policy rates, and again, they're sitting down, and we are seeing exactly what to do. On our side, we think they might hold it constant just to see how it plays, because we all know that when government makes policies, sometimes the effects lag on, so they might hold, they just cut it in the last meeting that they had, so they might hold on for a bit to see how it really plays in the market, so that there will not be as much pressure in the market. So if we go down to the next slide, this interesting chart, our budget deficit always in the reds. So we've had a persistent budget deficit. This is pre-COVID and post, still in COVID. You can see the rise, 42 billion, 37 billion, and the IMF is expecting it to increase like about 14% again. And because of this, again, as Jojo mentioned, government is going to fall on domestic investors, because foreign investors, with the news on Fitch, started exiting. But interestingly, we realized that Fitch was just downgrading us to what the other peers, its peers, had done. And the interesting thing is that last July or June, one of them, when they gave us a rating, they rated us the same, but they gave us a negative outlook. And for that, that was a sign that they were about to do something interesting. So we see this budget deficit, and we see rising interest debt to GDP levels. With that, government has to be able to finance all these deficits. So we see a lot of pressures coming in. If you go to the next slide, historically, government has again depended on the local markets to do something for them, do something small for them. So because foreign investors are not keen on investing in our country at the moment, you're probably going to see a lot of pressure in the domestic markets. And with pressure in the domestic markets, yields are likely to rise, because they are going to say, you have to give me a back of my money. I have to be able to invest in you and get some money out of it. And with that, that's what we call the risk-free. all these various big money players are going to pour their money into it. And then this deepens the allocation effect, where we're already trying to get just a little bit more flows into the equity markets. And now, because of higher yields, people are going to go into the fixed income market. So it's something that we have to think about. Moving on to the next slide. So just to touch on some forecast for the various industries. We're not really keen on the mining sector because it doesn't really trade as much. We're favorites for the banking sector because there's a high correlation between the banking sector growth in terms of equities and then fixed income, because a chunk and a very high percentage of their deposits go into investment in govies. And once it's risk-free, we know that there's no sort of risk that we'll be talking about. And MPLs haven't been inching as much. They inch just a little bit because of the commerce and finance and then construction. But aside that, for the other sectors, they sort of reduce. So we are not seeing much in the MPLs, and banks are not really lending as much. So we see banks doing quite well on the revenue side. So what mostly affects the banking sector are the interest rates. We have counterparty risk, which I've already mentioned, that's the MPLs. Then we have regulatory risk, which was well handled in 2018 when we did the banking sector cleanup. So we are quite bullish on the banking sector. And over the past few years, aside maybe last year when MTN was anchoring movements in the markets, the banking sector has done quite well to anchor the composite index. Speaking about MTN, the ICT sector, very bullish on the ICT sector because, one word, monopoly. MTN has a very large market share. It just showed its powers by increasing prices for its data, and nobody's making any noise about it. We are just all using the internet and all. So that's a very good point for them in terms of doing well. Look at food and beverages, which might be quite hit by inflation because of their cost. And also the benchmark values, the scraping of the benchmark values, because some of them source their raw materials from outside. So if any of them are in the 43 line items that might be affected by this policy, then we are going to see some increase in cost. That means that their top lines are going to be affected, and definitely their bottom lines will be affected because of the increase in cost. So we are not a bit too bullish on food and beverages. Distribution, that is the goals and the totals. Now oil prices are rising, so that's a very good place to be at this moment. But what you should be looking at is pricing power. So we have the goals, maybe governments might cap on the prices that they would be able to sell at, but some of them have quite some flexibility in terms of pricing power. So we also have to take a look at that. Manufacturing really doesn't do that much in terms of trade, so we're a bit neutral on that market. But again, bullish on banking and ICT. Insurance, also quite heavy on the fixed income market in terms of their investments, so it could be a good place to be. Emphasis on could be. So just moving to one of the last slides. This was supposed to be simple, relevant, but quite impactful. So I hope I've been very brief. So we'll just look at the summaries. If you can go to the next slide. So exchange done about 11.11% in dollar terms return for the last 5 years. We've had a decline in the number of stocks on the market. It's grown about 14% since 2015. Allocation effect, very skewed to fixed income. But if it's fixed, can equity markets handle it? No, they can't. Float effects, we have restricted trading. There's no flexibility in the shares that we have. And frankly, last year we saw some of this impact when it drove certain stocks up because they were hard to find on the market. And I think we have some traders here that will testify that it was quite hard to find in stocks on the market, and because of that, prices kind of shot up. We have the uncharted waters where we talk about what is happening in terms of the fiscal policies and how government needs to finance its deficit, and how it's going to put pressure on domestic capital, and they are in turn going to ask for better yields or more increased yields. And then we're going to see some deepening of allocation effect. We have the inflation plays in the food and beverage industry sectors, but we are bullish on banks and then on the ICT. So basically, these are our thoughts on the equity markets. So with the next slide, it's a goodbye from me.
Thank you very much, Na. Thank you for those thoughts and perspectives. Before we go into the panel discussion, we would like to do the charter holders recognition, right? Mawan? Is Mawan here? Okay, so we'll ask our founding president, those who laid their lives down for this society. They've shed blood and tears and brought us this far. We'll want to invite Clifford Mpari, Cfa, please. Never forget that one. You want to bring us greetings? Say hello. Say hello.
I don't know what to say, really. This has been a dream of mine for a number of years, to actually see a forecast dinner in Ghana. As most of you know, we started the CFA Ghana, which is one of 5 chapters in the whole of Africa, not too long ago. And it was a lot of work to get it started. But based on what I see this evening, it's clear to me that it's being moved forward quite aggressively by the new executives. And I certainly thank you to continue to do a good job. And I think Jojo's presentation certainly was worth hearing, and it had a lot of nuggets in it that I hope you will all take with you. And I am really an equity guy and worked pretty much in the equity field, mostly in my portfolio management life in the US. So the challenges that we are facing in Ghana gives me cause for concern. The fact that we have only 4% allocation in the equity market is not good enough, especially when you consider the fact that equities are based on the performance of the economy. So what does that tell us? If we have not had positive returns in the equity market for all these years, then our economy is not doing well. And there are several structural issues that we need to discuss to help us ensure that the equity market performs well. So I'm here to help to give out the various certificates. And like I said, it's a pleasure of mine. I got my CFA charter 31 years ago. That just makes me old, so don't worry about that. But it's quite an achievement, so we congratulate everybody who has been able to go through the difficulty of getting their charter. So that's a brief.
Thank you. Thank you very much. And I'll just mention the names, and if you're here, please come forward and get a handshake. 31 years ago. It was longer than some of the, some people are not born. Right. Okay, so we have Anthony Ejari Esiama, CFA. And we have Collins Baker Bonga, CFA. We have Emmanuel Ejam, CFA. And Emmanuel Ojembuachi, CFA. Yes. And then we have Eric Adorsey, CFA. Evans Hato, CFA. Frederick Dachomo, CFA. Henry Bruce Aqua, CFA. Then we have Julius Ebenezer Akpe, CFA. Oh, yes. Well, Julius is in a hurry, as always. Sedem Michelle Dono, CFA. You may be wondering why it's all guys. It's not a guy show, please. There was a lady, she couldn't make it, so I'll mention her name. Ikia Ichampoma Adaimensa. Please give her a round of applause. The only lady among men. And ladies, we can do it, can't we? We can. Thank you very much.
So we'll take this opportunity, since we have our founding president around, to help recognize the efforts of the previous board. So we'd like to ask Mr. Clifford Impari to please come back and assist us. I'd like to invite Ike Boama, CFA. Please show up. Ike used to be the head of the nomination committee, and after our AGM, we had to elect a new one, and per our bylaws, a former president becomes the chair. So currently our nomination chair is Mr. Clifford Impari, but we want to recognize the work done by Ike. Sure, why not?
So the inscription on this plaque says, honoring Isaac Boama, CFA, as chair of the nomination committee, in recognition of your dedication, commitment, and influencing service to our society.
Now, the second one goes to Deborah. Deborah was our finance, was a member of the board, and then the head of the finance committee. Unfortunately, she couldn't make it, so we are asking Helena to take this and then go and handle it over.
Helena, I'll read the inscription on this. It says, honoring Deborah Ama Akote, CFA, as treasurer and chair of the finance committee in recognition of your dedication, commitment, and unflinching service to our society. So that's the inscription.
Thank you very much, Mr. Clifford. Whilst Helena tries to put the things away, she'll come back and then take us through the panel discussion. Thank you.
All right, ladies and gentlemen, our time is fast spent, but we will take a few questions, and we'll just explore two things. And I know it's a passion of one of the panelists, so you let me bring them up first. We'll have Jojo Kakra Banaman, CFA, please. Sorry. And then we have Na Louisa. You can be sandwiched in there. I haven't given the yeah, I will. You don't get to escape. I haven't talked about this, the last panelist. He's the one who was recognized for his contribution to the society. He's Isaac Boama. He's a chief investment officer at IC Group. He's done a few things before, but he's a very important person in this industry. You see him, his size doesn't show, but he's very powerful like that. And when he opens his mouth, people, they just scatter. He's worked at Cedar Capital LLC in investment roles at Ghana Cocoa Board. He is a charter holder. You always have to add that. He holds an MBA from the University of Cape Town, and he studied political science. He's also an adjunct professor at the Ashesi University. So please, let's give it up for Ike. He has quite radical views, I call it. But he charts new paths, so it's good to listen to him. So ladies and gentlemen, welcome, welcome, welcome. And we're just exploring two things. And if there are any questions in the audience, we'll take it. But debt to GDP. Jojo, you said that the debt to GDP itself is not an issue, but is a cost of borrowing. So, does our cost to GDP, does our debt to GDP
I think that's a trick question.
No, I don't think so.
I think interest costs is a tricky one, especially when you look at it from a domestic perspective. Domestic interest costs is tied to inflation and is tied to the level of government borrowing. It's a supply-demand factor here as well. Detriment of equities. Government has a very huge appetite in borrowing, and for that reason, the market will always ask for higher interest cost. If government were to cut its quantum of supply on the market, interest rates would drop.
Okay, so is that to say that we shouldn't link the high interest costs now to the debt to GDP ratio?
I don't think, there are other comparable countries who have similarly high or higher debt to GDP ratios. The key issue for any country is your debt service.
Right.
Okay, and that's where you look at Ghana's debt service as of September being 11.6%. If you look at a country like Japan, where their debt service is sub 1%, their debt to GDP ratio is extremely high, but the cost of servicing that debt is extremely low. So that you don't have interest payments clouding out how much government spends in terms of the expenditure. In Ghana, interest payments is above 25% of budget. Whereas in other markets, if your interest payments is slap 5% of your total expenditure, you can actually spend more of your budget on capex and other developmental projects. So the cost of the debt is the problem, not necessarily the size of the debt. And I think a lot of people look at debt to GDP and make political noise on it. I think the issue really is on debt service, and that's where people should be looking at. And how do we bring our debt service lower? Because if you look at the data over the last 5 years, the debt service has been going up from 10% all the way up to 11.6%. And likely over the next 12 months, if not 24 months, we may end up above 12% in terms of debt service cost.
But you're looking at that 12% is the weighted average, right?
Correct. 12% is the weighted average, and you do have concessional borrowing there as well. So it just shows you how high our interest cost is as a country.
So maybe Ike, you should take this. Why are interest rates sticky downwards? Why don't they just move down? Because
honestly, it's a difficult question. And I like the fact that you are beginning to shift the conversation from debt to GDP to the cost of borrowing. In 2016, where our debt to GDP was relatively lower than it is now, our domestic average weighted cost was around 20. So whilst today is elevated, it's somewhere around 17.4, 17.2. So the argument that government borrowing increases our weighted average cost of debt on the domestic market needs a bit more interrogation, because we've had areas where our debt to GDP was quite low, but still the yields were high. Honestly, I don't have an answer to it. I just think that as an investing community, we need to begin to interrogate the question, because most domestic participants are banks and pension funds. And by the way, within the last 5 years, pension funds have grown from probably 6 billion to probably 30 billion. And yet still, our debt weighted average cost is high. And I think we should begin to, as a community, begin to have that conversation, because it probably is way beyond physicals, and we need to look at what exactly the Bank of Ghana role is and how the monetary side also, the fiscal side also assess. Because if you look at Bank of Ghana increasing the rate, in the COVID era, when they reduced cash reserves, it pushed a lot of money into the banking system. That found its way in the bond market. And immediately they reversed that cash reserves, we began to see banks beginning to come off of the bond market, and the yields began to spike. And this was compounded by the offshore guys leaving the market. Is it possible Bank of Ghana can consider reversing that decision to provide a bit of liquidity into the market? Because at the end of the day, in this country, money supply is the most difficult part. Liquidity is quite thin in our market, because a lot of assets are in fiscal assets, uncompleted houses, and so on and so forth, which doesn't find its way in the monetary sector. So we need to look at liquidity in the market to be able to bring our cost of borrowing down. Other than that, it just becomes too expensive for government, too expensive for company, too expensive for individuals like all of us here who want to maybe get access to mortgage. You cannot get access to it. So I think this, for me, would be key thing that everybody should take home and ask, why is our cost of debt too high? Because now it's affecting everyone.
So maybe I'll throw a question to everyone then, because we all have pensions. So now I'll come to you in a bit. But apart from Bank of Ghana increasing liquidity, like Ike has said, how would you feel just if you were the one managing your own pension? How would you feel lending to government at, what, give me a rate, at 8%? Jojo says 8%. Oh no, Jojo, that's sub inflation. Let's just say, okay, the target. So let's just say 15%. How would you feel? Assume that you are a pension fund manager. You're managing your own pension. You have 1 billion of assets under your control. Government is out borrowing in the market. How would you feel lending that money to government at 15%? Okay, let me stand so that I can get shaking his head. Okay, so how would you feel? I want to know, because I want us to take the conversation, bring ourselves into the conversation and ask ourselves, what will change? What will change? Will you lend to government at...
Hi, my name is AJ from Blackstar. I think it's a very good question, and in my opinion, the answer predominantly lies in where inflation is. If we can, I will happily lend to the government at 15% if inflation is in the single digits, because at the end of the day, is the real your purchasing power is what really matters. So a lot of the time, I think, when you look at the way inflation has played out, the government almost doesn't have that much option but to lend at these extortionate sort of rates. But to answer your question, I will happily lend to them if they can keep inflation at single digits.
What premium over inflation would you take?
Again, it's another very good question, and it's like a chicken and eggs problem, right? I think maybe 3 to 4% if they can consistently keep it that low.
Where are we now? 12.6? Yes. So 12.6, yeah, so 15.6, right? If you go to 3%. Thank you. Thank you very much, AJ. Okay, now, so, right. Someone wants to give government $1 billion at 8%, 15%. Oh, right, sorry. The name.
My name is Bertrand. For me, I will approach it from the government side. I think being close to government actions over the years, I think I will say that we tend to overrate our leaders. That is the truth. It's not any particular political party, but that is the truth. Because government action itself are the reason why we having these issues we have. Sometimes they have the opportunity to really push down the rate to the level that are within our peers. But the actions from themselves, then you wonder whether they really want rates to get to that level. For example, you have a particular period where rates are rallying. You have like within a week, interest rates are rallying over 200 basis points. And governments stamp in the market and then destroy everything. Then you ask yourself, why will they just wait? It's not as if, or they go behind doors and then issue bonds at levels that are 200 basis points above where market is. And then we come back here and then they come out and then start asking, why are rates high? I think it's a big problem. Thank you.
Thank you. The point is well made.
So I'm Henry Bruce Aqua. So, since we are all venting, we are not venting. I might as well just say this. So, about rates and everything. What is happening with the private issuances? Where they tell us they'll issue this much. Next time you see something is going on somewhere privately at 22% and the rest. Rever your book to rates you can't understand. But that's just by the way. We really need to come together and make a point on this. It's really worrying us. About the rates, I would definitely not want to give government that rate because even as it stands, the high rates they are giving us, if let's say you as an individual, you have a project in construction and 80% of your income goes inside, you should ask yourself the question, do you think your inflation is 15%? If iron rods are doubling in prices and all these things are doubling, your inflation is about 120%. So even the rates now is an issue. So I'm not about to give government any 15%. Thank you.
Thank you. Thank you. Right. Right. The problem is not, it doesn't have an easy solution, does it? You have a question. We are putting the question to you. But anyway, sorry, someone has a comment.
Yeah, okay.
Right. Yeah, Frank.
No, not a comment. I'm trying to offer my opinion on the question that was on the floor. My name is Frank Tibia. And the issue with the high rates, okay, well, as you know, interest rate, the inflation component, and then of course the real rates, which are going to tackle. Okay, I don't think we all know the issue is with the extent of inflation per se, has to do with the uncertainty in inflation. Because if you knew for a fact how much inflation was going to be, you could actually price it away, okay? And the reason why most people, and of course it's not just in our markets, in most emerging markets, it's similar, okay? If you go to the South American markets or the less developed economies in Southeast Asia, it's almost the same. It's the uncertainty in inflation that is a problem. So if you have, let's say, inflation at 10%, and you want your premium to be, let's say, 4%, what if at the end of the year, inflation goes to 12% or even more? Okay, so these are the instances that tend to kind of compel, you know, people to actually have a higher rate, so you can hedge that. Because our markets, our financial markets are not that developed. If you go to the more developed markets, then you would have people that will come into the market, okay, and bring products into the market for others to try to hedge away the risk in inflation. Because we said it's the risk that is a problem and not the level per se. So then that's coming the derivative products. And there's several of them in these advanced markets that people will take different sides. So that they'll bring derivative products into the market, okay, for those that they feel that, okay, if inflation goes like 2% up, just like an insurance product, somebody, you know, gets paid, or the other way around. So that institutions that have to, you know, issue debt are more confident that, okay, I don't really have to overprice this. Because there are instruments in the market for people, for me to be sure that this inflation that I'm estimating plus the premium, okay, is not going to affect me, because that uncertainty in inflation, I can hedge it away. So I believe that when our markets move away and there are more private, you know, players in the market, like you have in the US market, the Canadian market, and what have you, okay, and you can hedge that uncertainty away, we wouldn't have this issue happening. We need to get more private sector into the market. Government is just too much over here. And that's my 2 cents.
Thank you very much, Frank. And so, do you think that government can call our bluff? So assuming government comes to the market and is looking to raise an amount, and decides not to come to the market for, let's say, 2 weeks, will we have other options for our money? Someone has the mic. Oh. The audience have taken it over from the panelists.
It was just an addition to what he said, and probably also answering your question. So I think for me, I think there's almost a near natural demand for government securities, especially in the pension space, right? So sometimes I think if government want to probably compensate for foreign investors being in our markets, because maybe they need a 20%, because for a foreign investor, if you should factor in depreciation and all that, 20% might be decent, right? So I think for me, yes, government can call our bluff, cut rates, and it will still do. Pension funds are thirsty for government securities. They'll do. The alternatives are not, there isn't that much. I mean, they are very risk adverse if you look at the other, asset classes. And it's also counterintuitive. Pension funds, we saw allocation for government securities increasing, and also that for alternative investment also increasing. For anybody who is, in the pension space. They also do government securities, even though allocations for other asset classes have increased, like equities and alternatives, right? So yeah, back to your question, the government can call up bluff, cut rates, and also do, because there's...
Jojo.
For government to attempt to call the bluff, government has to look at itself first. One, government needs to cut expenditure. It is only by cutting expenditure that they would reduce their financing requirements. And when you reduce your financing requirements, then you can dictate as the supplier to the market what rates you want to pay. Government is the largest supplier of paper to the market. If government calls the industry and says, I'm willing to pay 15% for 5-year money, I'm only willing to pay 15%, the rates will drop to 15%. And guess what? If the market thinks the 15% is credible because government is not borrowing, government is not spending so much, inflationary pressures in the market are going to drop, the market will drop to 15%. But at this stage, when there is lack of uncertainty as to government's own appetite in terms of how much do they need to borrow this year, there is that lack of clarity this year as to what is the size of expenditure consolidation that government is going to do this year. What's the true size of borrowing that government is going to make this is going to be requiring this year? Then at that point in time, the market says, you know what, even 22% is not enough. I'll take 25. And that is what government is losing out. Government has the muzzle to determine where interest rates should be. And I like the point from my colleague Bernard. If government really looks and understands and analyzes the market, there will not be occasions where the market is at 16% and all of a sudden you see a particular bond on the market at 17% because government has given out some juice on the market. Okay, so I think that it can be done, but government needs to cut itself first.
So now, my question to you is that, I mean, you indicated what the allocation effect is, that there's more money to, I'm sure Jojo has hinted on that, but there's more money to fixed income as a class than equities. What do we practically do to shift this?
Good luck. Thank you, Ike. I think there are lots of moving parts to this because it's not just one party that has to solve this problem. Again, I pointed out that the equity markets doesn't even have the capacity to receive the funds if there's a lot of inflow. Government needs the money. So they will definitely push the allocation for equities, push the allocation for fixed income more than equities. But just touching on all the questions we've asked, what I personally think, and I'm moving away from cost, I'm moving away from all the interesting things and the ventings that have been mentioned. But as a country, we should start thinking of producing. This is how we solve our problem, to produce. You see debt to GDP, that's a ratio. Debt swelling up, GDP sort of shrinking, sort of staying the same. So if you increase the baseline, if you increase the denominator, it's going to swallow up the debt, right? So as a country, if we begin to push more on producing, then I think that we'll be able to start solving a lot of the problems that we see on our markets today. And the rates that we are all talking about, risk is being priced in it. If I know that government is definitely going to refinance and is not going to get money from, say, the industry sector in terms of revenue mobilization or any other sectors where it needs to get the money from, I would definitely price in that risk there. But if I know, and we have countries like Japan and the others, they are more industrials, they produce. But we as a country don't really produce as much as we are supposed to produce. So that's what I think will solve the problem. Once we start focusing more on producing, spending more in terms of looking at the agriculture sector, our industries, then we are going to be able to start doing some serious revenue mobilization on that, and then blow up the GDP to swallow the debt, then we can start solving our cost problems.
No easy way out. So your final take. What response or move from regulators or market participants could be a game changer? Or do you see one? Any move from regulators, from market participants that could be a game changer? I want to take it away from government a bit, just to see what our role is. Anything from market participants, from regulators, and I didn't like it that Abner left. So I'm talking Bank of Ghana, Securities and Exchange Commission, the Ghana Stock Exchange, the Pensions Regulatory Authority, and then market participants. What could be a game changer, Ike?
Thank you. So here I'm speaking more as a money manager than as a Ghanaian. So forgive me for that. Our fixed income markets, as Nas said, basically swallows our equity markets. And if you're going to do production, you need long-term capital. What is it with our system is that all of us are used to certainty of returns because we buy treasuries. And most of us mark to book those treasuries. And so even though interest rate is going up, and so in effect, your actual market value is going down, you compare a mark-to-market asset, which is equities, to a mark-to-book asset, which is treasuries. And so that's even a bad start for those pushing for equities in the first place, because when interest rates are 21.2 and your actual bond value is going down, you compare that my income is 21.2 and your equities is giving me 5%, I'm not going to buy. But then when you look at the market value of what you're actually holding, it's probably lower. So I think regulators need to look at beginning to initiate a conversation on marking to market bonds in this space. In that way, you introduce this variation in returns, and you push people to begin to accept the fact that there's a risk and there's a return, and people will begin to get used to equities upswing. Then cash can come into the equity market, and people can begin to move into the equity market and go for longer term capital. But at this rate, when government on one hand is saying, go and buy equities, but on the other hand, we are doing a mark to book on the largest asset class in our market, how do you convince my mother to buy equities when you can simply buy something at 21.2? She doesn't mark to market. And so how do you start that conversation? So I think regulators need to look at this, because other than that, it's not even a start. Equities cannot win the conversation anytime soon. Thanks.
No, I think I side with Ike on this. So yes, definitely everything I said.
Just to add that the number of equities listed as stocks on the stock exchanges will woefully inadequate. A lot of the very good companies in Ghana are owned by government. The size of government is too big. Government should consider diversifying some of these entities by listing them on the stock exchange. That would then move ownership into pensions and free up a lot from government in terms of expenditure as well. So yes, there may be national assets, but the Ghana airports, Ghana ports could be listed on the stock exchange, and definitely those are viable earning assets that pensions could actually invest in, and definitely increase the amount of equities and the float as now put out there. I think that will be essential to change the narrative within the industry. Obviously, in line with what Ike said as well, if you're marking to market your bond book and your equity book, then you are comparing apples to apples and not apples to oranges, and that's also essential as well. And that change has to be done from a regulatory perspective to ensure that the industry actually moves on and evolves. It's similar to what we saw with the gifting market. We need to have something that drives the equity market accordingly as well.
Guys, I thought you would clap for them. Yes, we are done. We'll give our president, former president, the last word, but we are done. And So our takeaway, and maybe Nana will have to pursue this, is how to move this discussion forward, engaging the regulators, because our key takeaway is that, look, we cannot be comparing apples to mangoes and saying that mangoes are bad. So let's compare apples to apples. Let's price our bond books, let's price equity, and let's see what that does for the market. And that discussion can be taken at the regulatory level. So maybe we could move this forward by engaging the regulators and see how we can, it's not going to be an easy discussion. There are cultural, I think that some of it is also cultural because we're just used to high rates. Telling your mother that I'm holding a bond, I'm not ready, I'm not selling it, but the value has gone down. I don't know how I'm going to explain that. But if that is where we need to move the discussion to so that we can move this forward, then we need to do that. And I think that you've all done justice to the issues. Thank you very much. Thank you, people. Please give them a round of applause.
I could tell people didn't want us to close. The discussion was becoming more interesting. So at this time, I don't know if it's too late for you to eat, but I have some food available. If I had served the food while you were talking, I'm not sure you would have participated so much. So I think in fairness, we'll take it and then we'll come in. So just in an orderly, simple fashion, please note that we are having dinner. After we'll come and talk again. Thank you. I think let's try and use the tables. Maybe those who spoke and have used all their energy can go first, and then we can follow, please. Thank you very much.
Sometimes in our life, we all have pain, we all have sorrow. But if we are wise, we know that there's always tomorrow. Understand, we all need somebody to lean on. Need a hand. We all need somebody to lean on. Might have a problem that you'll understand. We all need somebody to lean on. Call me get up, get up, get up. Let's make love tonight. Wake up, wake up, wake up, wake up. 'Cause you do it right. Baby, I got sick this morning. A sea was storming inside of me. Baby, I think I'm capsizing. The waves are rising and rising. And when I get that feeling, I want sexual healing. Sexual healing is good for me. Makes me feel so fine. It's such a rush. Helps to relieve the mind. And it's good for us. Sexual healing, baby. It's good for me. Sexual healing is something that's good for me. And it's good for me. And it's so good to me, my baby. Come take control. Just grab a hold of my body and mind. So we've been making it, honey. Oh, we feeling fine. My medicine. Open up and let me in. Darling, you're so great. I can't wait when you're off the base. Get up, get up, get up, get up.
Okay. Good evening, everyone. Good evening, ladies and gentlemen. My name is Emmanuel Ojemboache, and I'm here to give the closing remarks. But before I give the closing remarks, can I see by hand Emmanuel Ijam? He's not around, eh? Yeah. Before I give the closing remarks, I'd like to say one big joke. I mean, Emmanuel Ijam and my name seems to be very similar. I'm Emmanuel Ojem, and he is Emmanuel Ijam. It starts with E, my own starts with O. So I quite remember one of the CFA exams, level 3, hard one. I go say that the thing bad me. I stood up from the people and I know say this one there, Mediegu. So I was quiet. I come, I did my bed now. Then my friend will call me, say, hey, Charlie, you blow the people the way you did chat for the platform top. I said, me. Say, who they do this? How do they like that? I don't know. My bomb being here, say me quiet. Who they say? Then another person call me. Charlie, now you that say you blow like that. That's why I don't see. So I was like, So I had to quickly go on the platform and say that, there's a difference between Emmanuel Ojem and Emmanuel Ojam. In fact, the guy speaking is Emmanuel Ojam. When the results come, go and ask him. Don't come and ask me. So, I mean, I was happy to see him today, that we all had to get our chatter. And I would like to say a very big thank you to our founding fathers. Without them, we wouldn't have been here. There wouldn't have been any CFA Institute for us to even have a forecast dinner. And I would also like to extend a big thank you to our panelists for the wonderful presentations and the thought-provoking angles which they drew our attention to. In fact, I had a question, but Helena didn't allow me to ask. I wanted to ask why the difference between the cocoa bills
of equivalent yield to government seems to be priced at a premium? Because I don't understand. They are all government, exposure to government. Or is it because our appetite for high interest rate is high? So cocoa bills are always priced at a premium to government. So I didn't ask, but I will see you and take the answer. And also to everyone gathered here, I will say a very big thank you for honoring our invitation. We have a line of activities for this year. Key among it is a CFA Annual Research Challenge, which is the maiden event also. So we entreat that when the time comes, you come in your numbers as you've done today. And to all aspiring to be CFA charters, I think the mental build up or what you stand to gain by just going through the documents is immense, and I will entreat you to gather the courage and start the process so that in some few years down the line you will all become charter holders. Thank you very much for honoring our invitation, and I will say God bless you. Bye. So I'll invite the President to give us the closing prayer.
Sorry. After there'll be some photographs, but I just want to ask you all that when you are done, please, we'll have to keep. Hey, maiden, we need to keep a photo of all of you, maiden, together. So thank you all. Oh, you want closing prayer too? Okay, so as you're eating, please close your eyes. Father, we are indeed grateful to you for the opportunity to have had a successful program. We ask that you carry us safely home. And just as we began by asking that, may this program be a success and may it continue to be an annual event. In Jesus' name we pray thanksgiving. Amen. Thank you all for coming.